Welcome back to the Daily Economy 24/7, where our community comes together to make sense of the world, one story at a time. If you're tuning in today, you're not just a listener. You're part of a growing family of people who want clarity, truth, and deeper understanding in a world that moves fast. Every episode we create is built with you in mind, your curiosity, your hunger for insight, your desire to stay informed and grounded. And if you're new here, welcome. Settle in. You're in good company. Before we dive in, I want to invite you to get involved. Subscribe, share your thoughts, drop a comment, or pass this episode along to someone who would appreciate it. This channel grows because of you, your voice, your engagement, your presence. Alright, let's get into today's episode. The global economy is heading into 2026 with a strange mix of resilience and fragility, a world that is growing, but unevenly, stabilizing, but cautiously, expanding, but under the shadow of structural change. After years of volatility, policy shocks, inflation waves, and labor market distortions, 2026 is shaping up to be a year defined not by crisis, but by rebalancing. According to Goldman Sachs, the global economy is projected to grow 2.8% in 2026, outpacing consensus expectations. The United States is expected to contribute significantly to that momentum, with growth around 2.6%, while China is projected to expand by 4.8%, continuing its slow but steady post-pandemic normalization. This is not explosive growth, but it is sturdy, stable, and surprisingly resilient given the headwinds of the last several years. Morgan Stanley's 2026 outlook echoes this theme. They expect the U.S. economy to emerge from the policy uncertainty of 2025 with moderating inflation, easing tariff pressures, and a labor market that begins to loosen without collapsing. Their economists describe 2026 as the year when the aftershocks of political and policy turbulence finally begin to fade, allowing the economy to settle into a more predictable rhythm. But predictable does not mean simple. And stable does not mean unchanged. Because beneath the surface of these forecasts lies a deeper story, a story of structural shifts, demographic pressures, technological acceleration, and global realignment. 2026 is not just another year in the economic cycle. It is a hinge point, a year where the old model continues to fade and the new model becomes impossible to ignore. The first force shaping 2026 is labor market normalization. After years of tight conditions, worker shortages, and wage spikes, the U.S. labor market is expected to show more slack. Morgan Stanley forecasts weaker job growth early in the year, followed by a gradual stabilization as inflation cools and businesses regain confidence. This doesn't mean mass layoffs, it means a return to balance. A return to a world where job openings and job seekers move back into alignment. But the second force is more structural: automation and AI adoption. Even as the economy stabilizes, companies are accelerating their shift toward AI-driven efficiency. Productivity gains are expected to rise, but job creation may lag, a dynamic Goldman Sachs describes as sturdy growth, stagnant jobs. This is the paradox of 2026, the economy grows, but the labor market evolves in ways that challenge traditional expectations. The third force is global divergence. Moody's forecasts a world where advanced economies grow modestly, while emerging markets maintain stronger momentum. The US remains the anchor of global stability, Europe continues to struggle with structural stagnation, and China navigates a slow growth transition. Trade tensions, especially between the US and China, remain a wild card, with the possibility of deeper decoupling shaping supply chains, investment flows, and geopolitical risk. And then there is the fourth force, inflation's final chapter. After years of volatility, inflation is expected to moderate meaningfully by mid-2026 as tariff effects fade and supply chains fully normalize. But the risk of sticky inflation remains, especially in the US, where strong consumption and populist policy choices could keep price pressures elevated. The Federal Reserve will face a delicate balancing act, cutting rates enough to support growth, but not so aggressively that inflation reignites. 2026 is not a year of crisis. It is a year of recalibration. A year where the global economy finds its footing, but on new terrain. The question is not whether the economy will grow. It's how it will grow, and who will benefit. Because the deeper story of 2026 is not about GDP numbers or inflation charts. It's about the transition into a new economic era, one shaped by technology, demographics, geopolitics, and the redefinition of work itself. And that story is just beginning. The story of 2026 cannot be told without understanding the labor market, because the labor market is the heartbeat of the economy. And in 2026, that heartbeat is changing rhythm. After years of tight conditions, worker shortages, and wage spikes, the US labor market is finally loosening. Not collapsing, loosening. Morgan Stanley forecasts that the US economy will grow 2.2% in 2026, supported by fiscal and monetary easing. But they also warn that wage growth will slow, inflation will remain above 2%, and affordability pressures will persist. This is the new reality, a labor market that is no longer overheated, but not fully cooled either. A labor market that is stabilizing, but still under structural pressure. The biggest force reshaping the labor market is not interest rates or consumer demand, it's AI-driven productivity. Goldman Sachs expects global growth of 2.8% in 2026, but they describe it as sturdy growth, stagnant jobs. That phrase captures the paradox of the modern economy: output rises, but headcount doesn't. Companies are investing heavily in automation, software, and AI systems that allow them to do more with fewer people. This is reflected in business investment forecasts. The Equipment Leasing and Finance Foundation projects 6.2% growth in equipment and software investment in 2026, a strong signal that companies are doubling down on technology, not labor. AI-driven capital expenditures are becoming the backbone of corporate strategy. And while that boosts productivity, it also reshapes the job market in ways that challenge traditional expectations. The second major force shaping 2026 is inflation's final descent. After years of volatility, inflation is expected to moderate meaningfully by mid-2026. Morgan Stanley notes that global inflation is slowing, giving central banks room to cut rates. But the US faces a unique challenge: strong consumption and lingering affordability issues could keep inflation slightly elevated. This is not runaway inflation, it's sticky inflation. The kind that doesn't break the economy, but doesn't fully disappear either. Consumers, meanwhile, remain surprisingly resilient. Healthy balance sheets, rising wealth, and easing borrowing costs are supporting spending. But the composition of spending is changing. Households are shifting away from discretionary purchases and toward essentials. They are prioritizing value, durability, and necessity. This is not a recessionary mindset, it's a recalibration. A recognition that the world has changed, and that financial decisions must change with it. Housing remains one of the most complex pieces of the 2026 puzzle. Rate cuts will bring some relief, but affordability challenges will persist. Home prices remain elevated, supply remains tight, and demographic pressures continue to push demand upward. The result is a housing market that is stabilizing, but still strained. A market where buyers are cautious, sellers are patient, and builders are navigating higher costs and uncertain demand. Globally, the picture is mixed. Moody's describes 2026 as a year of steady but subdued growth. Advanced economies grow modestly, emerging markets maintain stronger momentum, and geopolitical tensions continue to shape trade and investment flows. The possibility of deeper US-China decoupling remains a wild card, with rising restrictions and uncertainty influencing supply chains and global risk. But despite these challenges, the global economy is not fragile, it is adapting. Deloitte notes that after a turbulent 2025 marked by trade barriers and policy shifts, 2026 brings a return to predictability, even if at higher costs. Countries are renegotiating trade relationships, rebuilding supply chains, and adjusting to a world where economic blocs matter more than global integration. This is the new economic landscape of 2026, a world that is growing, but unevenly. Stabilizing, but cautiously. Expanding, but under the shadow of structural change. The question is not whether the economy will grow, it will. The question is how it will grow, who will benefit, and what the future of opportunity will look like. Because the deeper story of 2026 is not about GDP numbers or inflation charts. It's about the transition into a new economic era, one shaped by technology, demographics, geopolitics, and the redefinition of work itself. And that story continues in the next part. Every economic outlook has two sides: the risks that could derail the year, and the opportunities that could redefine it. And 2026 is no exception. In fact, the stakes are higher than usual because the world is transitioning, not from crisis to recovery, but from volatility to a new equilibrium. A new normal. A new economic architecture. To understand where 2026 is heading, we have to begin with the risks, not to fear them, but to see them clearly. The first major risk is policy uncertainty. Even though 2026 begins with more stability than 2025, the aftershocks of political decisions still ripple through the economy. Tariffs, trade restrictions, and regulatory shifts can alter inflation, supply chains, and business confidence. A single policy misstep, a tariff escalation, a regulatory freeze, a fiscal shock, could slow growth or reignite inflation. The economy is stable, but not invincible. The second risk is global fragmentation. The world is no longer moving toward integration, it is moving toward blocks, toward alliances, toward economic spheres of influence. The US and China continue to decouple in technology, supply chains, and investment flows. Europe faces structural stagnation. Emerging markets navigate currency pressures and geopolitical tensions. Any escalation, a trade conflict, a sanctions dispute, a supply chain disruption, could reshape global growth in an instant. The third risk is persistent affordability pressure. Even with inflation cooling, prices remain elevated. Housing is still expensive. Healthcare is still costly. Food and energy remain volatile. Consumers are resilient, but they are not limitless. If affordability worsens, spending could slow, and with it, the momentum of the entire economy. The fourth risk is labor market mismatch. Even as the job market loosens, the gap between the skills workers have and the skills employers need continues to widen. AI accelerates this mismatch. Companies automate faster than workers can retrain. Productivity rises, but opportunity becomes uneven. This mismatch is not just an economic issue, it is a social one. It shapes identity, mobility, and the emotional landscape of the workforce. But for every risk, there is an opportunity, and 2026 is full of them. The first opportunity is AI-driven productivity. For the first time in decades, the world is on the verge of a productivity renaissance. Companies are investing heavily in automation, software, and intelligent systems. These investments take time to pay off, but when they do, they can lift growth, reduce costs, and expand output in ways that reshape entire industries. 2026 could be the year where productivity finally breaks out of its long stagnation. The second opportunity is monetary easing. With inflation cooling and growth stabilizing, central banks have room to cut rates. Lower borrowing costs support housing, investment, and consumer spending. They give businesses breathing room. They give households relief. They give the economy momentum. Rate cuts are not a magic wand, but they are a powerful tailwind. The third opportunity is global diversification. As supply chains shift, new regions rise. Southeast Asia, India, Latin America, and parts of Africa are becoming engines of growth. Companies are diversifying production, investment, and talent. This creates new markets, new partnerships, and new opportunities for global expansion. The fourth opportunity is the redefinition of work. The structural shift is disruptive, but it is also creative. It opens doors to new industries, new roles, new forms of entrepreneurship. It rewards adaptability, creativity, and innovation. It challenges workers to build new identities, new skills, and new pathways. The future of work is not narrower, it is broader. But it requires courage, resilience, and a willingness to evolve. And then there is the long-term trajectory, the road beyond 2026. The world is entering a decade defined by three megatrends. AI, automation, robotics, and digital infrastructure will reshape productivity, labor markets, and global competition. The winners will be those who adapt fastest. Aging populations in advanced economies, rising youth populations in emerging markets, and shifting migration patterns will redefine labor supply, consumption, and economic potential. The world is moving toward blocks, US, China, Europe, and emerging coalitions. Trade, technology, and security will be shaped by alliances, not globalization. These megatrends will define the next decade, and 2026 is the year where they begin to crystallize. The global economy is not fragile. It is evolving. It is recalibrating. It is finding a new equilibrium. 2026 is not a year of crisis. It is a year of rebalancing. A year where the world steps out of the shadow of volatility and into a new era of stability, even if that stability looks different from what we once knew. The question is not whether the economy will grow. It will. The question is how it will grow, who will benefit, and what the future will demand from all of us. Because the deeper story of 2026 is not about numbers, it's about transformation. It's about the transition into a new economic era. It's about the choices we make now that will shape the next decade. And that story is still being written. Thank you for spending this time with me today. Every download, every listen, every comment, it all helps build a community that thinks deeper, learns together, and stays grounded in a world full of noise. If today's episode resonated with you, I'd love for you to stay connected. Follow the channel, share this with someone who needs a clearer view of the economy, and jump into the conversation. Your perspective matters here. Your engagement shapes what we explore next. This isn't just a podcast, it's a movement of people who want to understand the world, not just react to it. Stay curious. Stay engaged. And stay with us as we continue to break down the stories that shape your financial reality. This is the Daily Economy 24/7, and we're just getting started.